Live from Bloomberg's world headquarters in New York, I'm Scarlett Fu.
And I'm Tim Stanivek. Welcome to Bloomberg Crypto. It's a look at the people, transactions, and technology shaping the world of decentralized finance.
Here is what's at stake today. The Senate Banking Committee releases the text tied to the market structure bill. We dissect what it means for the crypto and banking industries.
On that, we're getting Coinbase's reaction to the bill. We've got Calvert joining us in just a few minutes. She's the firm's vice president of U.S. policy.
And Kalshi reaching a valuation of $22 billion and making a key hire tied to compliance. We're going to talk the latest in prediction markets.
That's all ahead on Bloomberg Crypto. First, though, we got to check out where things stand with digital asset prices. Looking at Bitcoin, barely hanging on to that $80,000 as inflation risks come into play, especially in today's trade. If you look at the action over the last 8 days, you can see there was a high back on the 6th of the month, $82,769. Fell over the next couple of days, that was last week, and then a little bit of a rally over the weekend, only to fall ever so slightly. But again, still hanging on to that $80,000 hit right there, up 0.3%, Scarlett, in the last 8 days.
Meantime, Tim, I am looking at crypto stocks. Coinbase, Circle, and Bullish, they are all off today by at least 5%, almost 6%, in line with declines in the broader market. Now, while there is movement on the Clarity bill, and that's good news for the overall crypto industry, analysts say that the new restrictions on stablecoins is going to eat into the reward programs that Coinbase and perhaps other companies offer. There may also be some concern that people may take some of their money back to traditional banks. Tim.
Okay, it's those traditional banks and the fintech firms that we want to talk about. We also want to get the details on the text tied to the structure bill. It's our weekly segment called Political Exchange. We're joined by Bloomberg Intelligence senior analyst Nathan Dean. He joins us from Washington, D.C. right now. Nathan, they released the text of this market structure bill overnight. What's in it?
So this text is actually fairly consistent with what we've been seeing over the last couple of months. This defines what is under the jurisdiction of the SEC, what is under the jurisdiction of the CFTC, and it provides regulatory clarity for companies like Coinbase so they can go forth and get the enforcement albatross off their neck. Now, there is still this discussion about stablecoins. What the deal essentially says is that rather than paying rewards through third-party platforms like Coinbase on the balances, going forward, you'll have to do it on transactions or market makings or for use of product and service. So, obviously those reward programs are going to be a little bit less of an emphasis going forward. But I would just say is that the clarity that companies like Coinbase get is certainly going to help them in the long run and certainly allow them to take up market share over to the detriment of the small mom and pop players going to emerge over the next few years.
Nathan, what are the banks going to like? What are they not going to like in this text?
So obviously they don't like what's going on with the stablecoin yield. I mean, obviously the American Bankers Association is leading the charge on this. They even sent out an email on Mother's Day telling their folks to call up on Capitol Hill and fight this, because under the idea here is that if I'm going to take 5% of my bank account and say, look, I want to put in the stablecoins, that's a deposit flight risk. Now the banks are going to push hard on this, but Senator Tillis and Senator Alsobrooks, the two senators that came up with this deal, they insinuated over the weekend that this is the done deal. This is not going to change. And so what I'm looking for in this Senate Banking Committee markup on Thursday is language that suggests that momentum is going to keep going. So even if you get some partisanship that comes out in the committee, as long as they keep going, I think this passes 60% chance by the end of the year.
What did Mother's Day call? Sorry, Mom, got to go lobby on behalf of the banks. Hey, Nathan, before we let you go, I'm curious about where it leaves the crypto firms. We're going to be speaking to Calvert over at Coinbase in just a minute. What do you think, not just Coinbase's reaction, but crypto firms? What's their reaction?
It's largely positive. There's some provisions in here tied to development, privacy that I think the crypto sector is going to like. But at the end of the day, it gets away this enforcement concern that was under the Biden administration, because everything that the SEC and CFTC are doing right now to provide clarity to the sector can be done away with the stroke of a pen if the Democrats win in 2028. This bill solidifies it, puts it in law, and would make it much more difficult to get this idea of regulatory ambiguity that we saw over the last 5 to 6 years.
All right, good stuff. Nathan Dean, Bloomberg Intelligence senior analyst, joining us from Washington, setting us up for our next conversation. As Tim mentioned, we are joined right now by Coinbase Vice President of U.S. Policy, Calvert. Kara, what is Coinbase's reaction to the text of the market structure bill that was released by the Senate Banking Committee overnight? Do you support it?
Well, thank you, Scarlett. We are very excited about the legislative text coming out last night. We're still digesting it. It's hundreds of pages. It's 9 titles. There are a lot of diverse new provisions. But I think at the end of the day, it is very consistent with what we've seen in the past, with some really important material changes. We identified back in January 4 different areas that we thought really needed to be improved, really before it could go and be ready for prime time, and all 4 of those have been addressed. That includes rewards issues, which I'm happy to talk about, also DeFi protections and developer protections. Third, making sure that we can take tokenized equities to market. That's a really new part of tokenizing our capital markets. And then finally, making sure that the SEC and CFTC authority is right-sized and we have the ability to issue these new exciting assets in the United States.
So going back to earlier this year in January, Coinbase killed the Clarity Act markup by pulling support over stablecoin yield restrictions. 4 months later, Brian Armstrong tweets, "Mark it up." What did Coinbase actually win in that negotiation? Was a 4-month delay worth it?
I think the delay would have happened with or without the markup. It would have had to happen before the markup or after the markup because there were really important material changes that needed to happen. So I think ultimately the process played itself out, and the provisions that have now been improved, I think, actually streamline this process. It will make us more competitive globally. It will allow developers and issuers to continue to develop and really innovate here in the United States. So the 4-month process, I think, played out, and ultimately we are right where we would have been, which is, I think, teeing up for floor debate, hopefully in the next month or 2.
Kara, what did Coinbase actually lose then? I mean, there was momentum that was lost in that waiting the 4 months, but what else was sacrificed in waiting this out?
I think the most important thing that happened, and there were, again, several areas that we were focused on, but the rewards issue is a really critical part of the future of stablecoin scaling and adoption in the United States. That was the goal of the Genius Act, and we felt like the #1 North Star that we needed to accomplish was to protect rewards for everyday Americans and to really protect the intent of the Genius Act. And the compromise that came out from Senators Tillis and Alsobrooks, is that how we would have written it? Absolutely not. Is that what we are willing to accept in a world where clarity for the entire industry is really the next step here? So I think the proposal is truly a compromise. The banks received everything they asked for, just shy of completely banning rewards for all Americans. So when we think about what is a metric of success is making sure that stablecoins remain competitive globally, making sure that everyday Americans can earn rewards so they actually want to switch and they want to use these better, faster, cheaper methods of payment. So that, I think, is a really key win, not just for crypto and not just for the banks, because I do think it is a win when we think about the opportunities, but it's really a win for all the everyday Americans who want to use stablecoins.
Let's push this forward to the midterms. If we're just months away from midterm elections, and I'm curious what Coinbase is doing ahead of those midterms, where it's spending money, who you're supporting, how are you thinking about them?
Well, the midterms are looming large right now. I think they're particularly looming large when you think about the 3.7 million Americans who have signed up for Stand With Crypto. That's the grassroots advocacy organization that really spans the entire country. And those are crypto voters. They are watching. They care deeply about this legislation. And I think that that is something you don't see very often from grassroots communities on an issue. This is something that they view as part of their economic well-being, some of their wealth generational wealth building. It's really important to our crypto advocates that this bill passes. So I think that they will be looking at what happens on Thursday. I think that they will be looking at what happens on the floor. This is the most bipartisan bill that has ever been written and taken to a markup. And I think that they are going to be looking to their lawmakers to support it.
You know, I think about the midterm elections, and I think about how Coinbase has been such a big player in elections overall, outspending any other crypto company on lobbying and political contributions. Brian Armstrong has a direct line to the White House. That's clear. You have a former Coinbase executive running Stand With Crypto. At what point does Coinbase's policy influence become a competitive moat rather than an industry-wide effort? And is that good for the crypto ecosystem?
This, I think, Scarlett, has been the most united we've ever seen the crypto industry. And that is saying something because this is a very diverse industry, from the smallest of your decentralized finance protocol developers up to Coinbase, where we are obviously the largest publicly traded company in the United States for crypto. And there's absolutely a united front on trying to get this legislation passed. That, I think, has been really key to its success. This isn't about any one company. Certainly, Coinbase has been here. We've also been here the longest. I started working for Coinbase back in 2016. This didn't happen overnight, and it didn't happen with any one political strategy. It really is something that has developed over a decade, and the united industry is what I think is going to help push it across the finish line.
Coinbase Vice President of U.S. Policy, Kara Calvert. Kara, thanks as always for taking the time and joining us on Bloomberg Crypto. Coming up, Kalshi hits a $22 billion valuation. DraftKings reacts to the competition in prediction markets. And also, this week, Ali Wallace, the global head of ETFs at Morgan Stanley Investment Management, spoke on ETF IQ about the growing acceptance of crypto in institutional banking.
It really did come about from client demand. So as you know, from a Morgan Stanley perspective, there has been several different announcements across our wealth and institutional trading in the last month or so. So it really is a firm-wide effort, but clients were asking, and I think there is still a big need for education around how this fits in your portfolio.
Let's get to the odds, an in-depth look at the booming growth of prediction markets. We want to bring in Bloomberg's Emily Nicole and Chris Palmieri. Emily is focused on Kalshi, joins us from London, while Chris is in LA looking at DraftKings, which just reported earnings not so long ago. Emily, let me start with you because Kalshi has been raising money and it now has secured a $22 billion valuation, which is quite a lot larger than what it was just 5 months ago.
Yeah, it's almost double what it was even just in the end of last year when it was at about 11 billion, and it's more than its rival as well. Polymarket, we had briefly heard, was chasing a number around that mark, but I think the most latest reports that we have put it at about 15 billion is what it's looking for now. So it definitely makes Kalshi the largest player, but it's also the largest regulated prediction market in the US. Polymarket, of course, much of its volume is on the offshore international platform that it has, while its US app is rather small at the moment.
So, Chris, come on in here. What does it mean for traditional, quote-unquote, traditional sports books? I'm talking about DraftKings. I'm talking about FanDuel, because they've been locked in this battle trying to maintain market share of their core businesses, while simultaneously, as you write, trying to fend off a new threat from these prediction markets.
Right, and those stocks have all taken a hit in the past year. And just to put it in perspective, Kalshi's $22 billion market value is bigger than DraftKings, bigger than Flutter, which is the parent company of FanDuel. So it's funny, as somebody who's covered this for a while, if you go back 8-9 years ago, DraftKings and FanDuel were the kind of new kids on the block, had this sort of quasi-legal product, Daily Fantasy, that was sweeping the country, and they were raising tons of money, spending as much as they possibly could on marketing and all that. And they became the two major players in online sports betting in the U.S. Now what they did is being done to them by the prediction market folks. They both launched products, are spending $200-300 million this year, each of them, on prediction market products, but right now don't have a lot of traction.
Right now don't have a lot of traction. What do we know in terms of how much prediction markets are contributing to their revenue line, to their bottom line, if they're even willing to go that far and share that kind of granular detail right now?
They didn't on the latest calls, and it's minimal at this point.
Hey, Emily, come on in here because Kalshi made a big hire today. Actually, somebody for policy coming from the working under Paul Atkins, who's now over at the SEC. It seems like Kalshi is really beefing up its presence in Washington. There was another big hire of late. A couple of weeks ago, we actually spoke to Kalshi's head of enforcement on our program, Bloomberg Crypto. Is the company successfully navigating a tricky regulatory environment?
I mean, successfully is a term, I guess, that's a matter for an opinion columnist. But at least in terms of what we're seeing in terms of its hiring in DC, it's definitely beefing up. There's also a major regulatory group that's been set up in DC, the coalition that's over there protecting prediction markets. Kalshi is a major part of that. It's definitely a major lobbying effort that's going on over there right now because, as we know, Kalshi is being sued and it's also suing a bunch of states all across the US that are disputing its right to offer predictions in their states, particularly around sports bets. That's a big area of contention. And lawmakers are incredibly interested in the power of prediction markets. We've been seeing headlines about insider trading on these platforms, some of which is being cracked down on, some of which seems to also still be going under the radar. So it's definitely an area that Kalshi and other companies are keen to beef up on, make sure they're talking to the right people, and also make sure their interests are being heard where, you know, they're facing their own legal issues.
So for Chris, for the DraftKings and the Flutters of the world, how are they moving forward with their planning, their rolling out of their prediction market product?
It's moving, whether you rapidly or not. I mean, their products are not up to where Kalshi is. Kalshi has all kinds of features that they've yet to roll out, all different kinds of bets that DraftKings and FanDuel are just getting started on. But it's still early days. They really just started in January. They both have said they're going to be a big push starting with the World Cup next month and then going into NFL season. So we'll see. But, you know, this is a unique time because, you know, prior to this year, you couldn't use FanDuel or DraftKings in California, where I live, for example. And now through this prediction market product, I can. So we'll see if that translates into more bettors.
Yeah, it seems like the established players who were the insurgents back in the day, Chris, have learned quite a bit from these new entrants into the market. A big thank you to both of you. That's Bloomberg's Emily Nicole in London, Chris Palmieri out there in Los Angeles. Well, coming up, we're going to talk to the CEO of WalletConnect, the firm out with a new report on the growth of stablecoin usage. And don't forget, you can access all the latest data and news on crypto, CRYP Go on the terminal. This is Bloomberg.
I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. inflation accelerating in April, with prices rising more than expected on the back of higher food and fuel costs. That increase being amplified by the ongoing U.S.-Iran war. That data hitting the stock market, the S&P 500 and NASDAQ 100 are both on track for their worst days since March. In the bond market, treasuries are selling off across the curve. The policy-sensitive two-year yield now pushing toward 4%. Meanwhile, oil markets are on edge after President Donald Trump said Tehran's response to his latest proposal was, quote, a piece of garbage, adding that the ceasefire is, quote, on life support. That said, he stopped short of threatening new military action and says a diplomatic solution is still, quote, very possible. Crude is sitting near $107 a barrel. And JP Morgan CEO Jamie Dimon says the market may be getting ahead of itself. He spoke earlier on Bloomberg. Let's take a listen.
I think there's a little bit too much exuberance out there. It's not just the Middle East. It's, Ukraine, Russia's still there, America, China. There are a lot of these complex issues which may or may not affect the market. But then there are issues like inflation. That today's print wasn't so good. So yeah, I think the market's kind of exuberant and it may not be completely justified.
Those are your midday movers. I'm Nora Melinda.
It's time now for Money Rewired, where we zero in on the ever-changing world of payments. I want to bring in WalletConnect CEO Jess Houlgrave because over 12 months, almost $300 billion in stablecoin volume moved across the firm's network. Jess, it's really good to speak with you. Within that volume, who or what is transacting in and using stablecoins the most right now?
Got it. Thank you for having me. So one of the big trends that we're seeing at the moment is institutional flows. These have been ongoing for several years now, but trends like tokenization of real-world assets, equities, bonds, etc., are really accelerating that, as is the adoption of DeFi by some traditional financial players. And then finally, and probably one of our fastest growing segments, is real payments use cases. And here we're talking consumer pay-ins and payouts. And that's about 1% of our network today. We expect this year that to grow a lot.
Who are those people and what are they spending on?
really varies by geography, actually. So what we're seeing in some developed markets is much higher transaction values, things like luxury goods, cars, watches, and other assets, often where card transactions are tapping out or where people are holding a lot of stablecoin or crypto assets and want to be able to spend them. At the same time, in more emerging markets, we're actually seeing a lot more of the everyday use cases. These are sometimes places where end consumers are holding stable coins, often as a hedge against their local currency inflation, and want to be able to use those assets on a day-to-day basis to buy coffee, to do their grocery shopping. So the whole spectrum and a lot of variety.
Using it on a day-to-day basis would involve merchant acceptance of stablecoins, and that seems to be one of the big barriers to mass adoption. What type of merchant, what kind of merchant would be ideal in being out front, in setting an example for others?
So we're seeing a lot of merchant demand, again, slightly in line with those segments and those geographies that I just mentioned. Other really popular merchant demand use cases are some categories like gaming, a lot of demands from merchants in areas where there's high volumes of international traffic. So think like European capital city, lots of people coming from all over the world with wealth that they want to spend on things like luxury goods. Some merchants do it because their end consumers are really pushing for it. Other merchants, it's a sign to the market that they're forward thinking and that they want to attract new customer use cases. And for a lot of them, I think the big change has been that crypto acceptance is becoming easier than ever. They no longer need to learn about crypto. They no longer need to train store staff to think about how to accept crypto and what a crypto payment is. Most of them now, I think, and certainly over the next 18 months, will be able to accept crypto payments via their existing acquirer and their existing payments partners. So it will feel very easy for them to enable this as an option.
You know, I want to think about settlement versus payment, because in the past, you've said people conflate settlement and payment. A lot of previous attempts to make crypto work, at least when it comes to point of sale, really hasn't worked. What is different in this moment?
So we are about to publish tomorrow a report on stablecoins, and one of the most interesting things that I found about the report was the number of people who want to pay with crypto. That's about 96% of crypto holders, and they want to be able to use it for payments. But 76% of people who've tried to make a payment in the last 6 months have failed, and that is because the user experiences today really poor in many cases. There are multiple clicks. People need to hold the native gas token in order to be able to effect a payment. Merchants have a limited number of assets that they can accept. So if you have the wrong thing in your wallet, you can't use it. And all of these things add a lot of friction to the end user. So what we're really seeing is those solutions where we make it as easy as possible. It's a tap or it's a one-click button, makes that transaction frictionless, makes it much more likely that the user can complete a transaction and therefore much more likely that they do a crypto transaction again. So this gap between demand for people to pay and how easy it is for people to pay is still there, but it's closing rapidly.
WalletConnect CEO Jess Houlgrave joining us from Lisbon. Thanks, Jess. Appreciate your time. Hey, coming up next, we're going to talk blockchain transaction oversight. Elliptic CEO is coming up. They just announced a $120 million financing round. This is Bloomberg. The real-time transaction monitoring platform Elliptic just raised $120 million. Participation from NASDAQ, Deutsche Bank, the British Business Bank. CEO Simone Maini joins us now live here in New York. Simone, welcome. Congratulations on the raise. I think a lot of people, would look at a description of what your company does in terms of surveillance and sort of understanding what happens in this ecosystem. Maybe they'll think of a company like Chainalysis. We have Jonathan Levin join us quite a bit. How would you draw a distinction between what Chainalysis does and what you do at Elliptic?
Well, thank you, Tim. It's great to be here. It's a really important day for Elliptic with this Series D fundraise. We've been in the space, ultimately pioneered the whole concept of on-chain analytics over a decade ago, and that longevity in the space is really, really important. What's important to know about Elliptic is we've had a really long-held conviction that traditional finance and crypto finance would converge. whether it took 5 years, 10 years, we wanted to be ready for that moment. And so we built Elliptic to really be bank grade before the space needed it for us to be.
Has that moment happened?
It's completely happened. The Pandora's box is open. You can just see in the news right now, whether it's Morgan Stanley, it's BlackRock, it's JP Morgan, the amount of activity, whether it's happening in stablecoins, tokenization, the activity that it's moving from off-chain to on-chain rails is absolutely happening. And you can also see that in Elliptic's fundraise with Deutsche Bank, NASDAQ joining the round, joining our existing investors, including JP Morgan, HSBC, Wells Fargo. I think that's a real demonstration that that moment certainly has happened.
Yeah, that's quite the lineup. So with this $120 million fundraise, what does this injection allow you to do that you weren't able to before?
So a few things. First of all, it's all about putting our market-leading products in more hands around the world. So we will be expanding into new markets, as well as doubling down in our existing hubs of London, New York, Washington, D.C., Singapore, but also opening in Brazil, Australia, Hong Kong, and elsewhere. Just with the growth of the market presents a huge opportunity for us to be able to do that. Secondly, and what I'm really excited about, is accelerating execution of our agentic product roadmap. So Elliptic has this incredible heritage and deep data set, and we're really known for being the #1 intelligence layer for on-chain finance. For us now is the moment where we can bring an agentic workflow layer on top of that.
So I'm curious about the real-time monitoring, the real-time surveillance that you do and that you provide to customers and to clients. What happens if Elliptic flags some crucial thing happening somewhere in the system that needs further action in real time? What happens? Take us through that.
Yeah, absolutely. So the advantage that our customers have when they're using a real-time solution like Elliptic is that they can detect that activity happening in real time. And that gives them the opportunity to block that activity before it comes onto their platform. So it's not only allowing them to comply with regulations, but it's allowing them to go further than that, to actually protect their institution from bad actor activity taking place in their ecosystem.
But detecting it and actually stopping it are two totally different things. What happens after you flag it? I mean, who actually has the power to shut down that transaction?
So that would sit with our customers, whether it's the exchanges, the custodians, the banks, those that are facilitating that on-chain activity on behalf of their customers. Elliptic is providing that intelligence layer, the risk alerting, and then ultimately it's with our customers to make a decision on how to respond to that intelligence.
The firm's more than a decade old, 2013, where it has its roots. I mentioned Chainalysis. It's been dominant when it comes to crypto surveillance. Some might argue you haven't scaled up as quickly as some of these other firms. Why is that?
So I can understand why you might ask that question. I would go back to really Elliptic's roots. As I said, we have been incredibly focused on how do we make sure we're building bank-grade compliance infrastructure instead of thinking about manual reactive investigations. Even though some parts of the market, particularly when it comes to the government segment, have grown faster in the past few years, what we've seen is a huge acceleration in the private sector recently. So Elliptic had its biggest growth year last year. So that's an incredible statement for a company that is over 10 years old to be accelerating its growth, and it really demonstrates Elliptic's belief and conviction in traditional markets coming on chain is proving out.
Simone, you came from Deutsche Bank and from Kroll. These are institutions in TradFi. They spent decades trying to catch financial crime in that space and didn't always catch them. Is blockchain analytics actually better at catching bad actors than traditional anti-money laundering systems, or are we at the risk of sounding glib, building the same flawed system, compliance system, just on different rails?
I think we have a huge opportunity in the blockchain space because of the transparency that the blockchain affords us. Sometimes people talk about the transparency of blockchains as being a bug. It's actually a feature. It allows us to see what's happening on chain. It's not designed to be anonymous, it's pseudonymous. That gives us immense power when it comes to detecting money laundering, sanctions evasion, and I think those are some of the the myths that we are often debunking at Elliptic, particularly when it comes to traditional financial institutions. But really, we're seeing a shift in that mindset. Folks that maybe have been skeptical in the past really now seeing actually there is huge power and opportunity when it comes to anti-financial crime to moving assets on-chain.
Simone Maini, please come back soon. Do not be a stranger.
Thank you so much.
Good to have you on Bloomberg Crypto. That's Elliptic CEO Simone Maini. Coming up next, the CEO of SocGen's digital asset arm discusses their recent expansion for its dollar stablecoin. That's next on Bloomberg Crypto.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, the S&P 500 and NASDAQ 100 are both on pace for their worst days since March, with the NASDAQ 100 now lower by more than 2%. This comes as Wall Street reacts to a hotter than expected April U.S. inflation print, the increase being amplified by the ongoing U.S.-Iran war. When looking at the big decliners in the session, you see names like Qualcomm, Micron, and Intel among the primary laggards. And JP Morgan CEO Jamie Dimon says the market may be getting ahead of itself. He spoke earlier on Bloomberg.
Much exuberance out there. It's not just the Middle East. It's, Ukraine, Russia still there, America, China. There are a lot of these complex issues which may or may not affect the market. But then there are issues like inflation. Today's print wasn't so good. So yeah, I think the market's kind of exuberant and it may not be completely justified.
Finally, outside the U.S., a South Korean ETF is tumbling, following a broad sell-off across the nation's equities after a policymaker said the nation should pay citizens a, quote, dividend using tax on profits from AI. Those are your midday movers. I'm Nora Melinda.
Societe Generale is expanding the reach of its U.S. dollar-denominated stablecoin through a partnership with Consensus. Let's discuss what this entails and the expectations for it with the CEO, Jean-Marc Stenger. He joins us now from Paris. Jean-Marc, thank you so much for joining us on Bloomberg Crypto. You have not just a dollar stablecoin, but also a euro stablecoin as well, tokenized bonds and structured products, all while being one of Europe's largest banks. SocGen has said it wants to bridge TradFi and crypto. But you look at the biggest stablecoins, dollar stablecoins like USDC and USDT, they already have more than $200 billion in circulation. What does a bank-issued stablecoin prove? What's the use case for it in this kind of market?
Yes, sure. And good morning, and thank you for having me. So indeed, Societe Generale-Forge is the crypto asset arm of Societe Generale, the French bank, and we are developing actually a full range of services in the crypto asset space. And in that context, it appears very crucial for us, but also for our clients, to be able to propose some cash solution on chain, and the reason for us to develop this stablecoin, the euro convertible and the USD convertible. We have seen lately a very nice uptick on the euro side with McHugh, shaping the crypto landscape very quickly in Europe. We see very high demand for that. We are now turning also to dollar precisely to accommodate broader use cases, but also to prepare, I think, for what is coming in the US with the Genius Act notably, which we think will dramatically reshape this market globally. And to your question, I think that's also why we are very pushy at the moment on this. We think it's a very young market still. Indeed, there are already a few players which are very large in that space, but it's a very young market actually. It's a young market for institutions. Clients we see from the corporate side or more institutional clients are only turning to stablecoin solution at the moment. So beyond the historical use cases we have all seen in the crypto space, I think there is much more to come from the client side, and that's where we want to position ourselves.
Jean-Marc, perhaps you just answered this question when you talked about what a young market it is, but I think a lot of people, when they think of stablecoins, they think of Circle, they think of Tether. What does a bank-issue stablecoin, though, provide that those don't?
Well, first, I think we should recognize that regulation is only coming to this market now, and that's why I'm saying it's a young market. And regulation is fueling a full range of new demand and services in that space. So a bank, I think, in this environment is very credible and a very natural player for clients to accommodate existing use cases and existing needs we are serving in this context. Again, payments, for instance. Clients are turning very naturally to their banks to process payments.
Yeah.
I think as a bank and as the crypto arm of a bank, we need to provide innovative solutions in that field. And again, that's why we are promoting these stablecoin solutions at Societe Generale-Forge.
But you're definitely in competition with U.S. companies like Circle. I wonder how the U.S. government views a European bank issuing dollar stablecoins. Have you been pushed on that question?
Actually, it's a global market. So indeed, there are already very large US players. I think there is room in the market for very large European players, and we are definitely positioning ourselves as a credible and reference stablecoin issuer in Europe with ambitions which are global. Again, it's a global market. Clients need both USD and Euro stablecoins, and clients need, I think, a European issuer in that space. So, I mean, clients will decide, and competition will happen in the market like everywhere. Again, in a regulated environment, which is emerging with MiCA in Europe and with Genius in the US.
On stablecoins, what level of demand are you seeing from clients right now? What are some of the use cases? Why, and why are they using it and not tokenized deposits?
Yeah, the demand we see at the moment at Societe Generale-Forge is coming from the crypto native players which are active in Europe. MiCA is in place for a bit more than a year now. It's definitely reshaping the market. We see a demand emerging for Euro stablecoins, which was not the case probably a year ago. So I would say our core domestic market is definitely Europe and MiCA regulated stablecoins in Euro. But again, the same clients and new clients we see coming to these payment solutions, corporates, financial institutions, do require as well a USD payment tool, like a USD stablecoin. And again, that's why we have decided to expand the reach of our stablecoin, notably through this partnership with MetaMask. But we are also now going for other use cases. I'm thinking, for instance, to collateral management and margin calls, which is a very important need for institutions. And that's why we are developing ourselves beyond the first use cases we have been promoting.
Jean-Marc, if we're still sitting here in 3 years' time and still talking about tokenization and digital assets in a more theoretical way as opposed to a practical way, a concrete way, they haven't really scaled in banking in particular. What do you think will have gone wrong in that scenario?
I think it's happening. I don't think anything is going wrong. We see a lot of concrete projects with clients and counterparts. For instance, on our end, we'll start building solutions with clients, with real counterparts when it comes to collateral management. And that's also developments we see at scale happening now. I think it's just the ramp up which is starting. I know the market has been talking about that for a while, but from what we see and the discussions we see with clients is happening for real.
All right, Societe Generale-Forge CEO Jean-Marc Stenger, thank you so much for joining us today. Jean-Marc joining us from Paris. We had some headlines crossing just a few moments ago. Kevin Warsh was confirmed by the Senate to join the Federal Reserve Board of Governors. So that is the latest here on the central bank and its leadership. You look at the markets, not much movement there. That was expected. Equities are at their session lows right now, with the S&P 500 losing about 1%. A vote on his chairmanship, by the way, is set to take place tomorrow. Coming up next on Bloomberg Crypto, we stay global and focus this time on the Middle East. VARA is Dubai's crypto watchdog, and the head of Asheron's, Sean McHugh, joins us to talk about the region's role in shaping the virtual assets ecosystem. This is Bloomberg Crypto.
Well, VARA, it stands for Virtual Asset Regulatory Authority. It's the government agency in charge of controlling and watching over all cryptocurrency and digital asset businesses in Dubai. The agency's head of market assurance, Sean McHugh, happens to be here in New York, and he joins us on set right now for Bloomberg Crypto. Sean, good to have you here in New York. We've spoken when it's been, late at night where you are. Look, we got to start with geopolitics and what's happening with the war right now, because a lot of people before this war, Dubai was this sort of sanctuary in the Middle East where a lot of entrepreneurs would go, a lot of crypto folks would go to do business. I think a lot of people now are saying that's been called into question, the safety and security of it amidst this war. What's your view there?
Well, so I've been there about 2 years, and I've been living through this. It's still all those things, and it'll be all those things after the crisis. This is a bit episodic throughout the entire Gulf. Qatar and other Gulf states are going through the same. But it hasn't changed the strategy of Dubai. There hasn't been exodus of people and that sort of thing. We're still as busy as we've ever been, and we haven't seen a single firm in our licensing pipeline that has said we want to scale back or pause.
So business as usual?
Yeah, I in the crypto space for sure, right? And a number of other industries as well. We've licensed 49 firms, 9 this year, 7 since the conflict started. Many of them were in the process prior, but for us, we're moving and grooving.
Meantime, you look at what's happening in the U.S. There's definitely some movement on the Clarity Act this week, and in fact, we might get a full Senate vote fairly soon. So with the U.S. aggressively courting crypto companies to move back with regulation and a friendlier SEC, we've also seen Europe, of course, do quite a bit on the regulatory front as well. Singapore and Hong Kong are very competitive on this front, too. You've said that in the past, Dubai is a jumping off point for firms going east and west. But if we see the U.S. and European regulatory efforts on crypto really come together and those houses are in order, does Dubai's advantage start to disappear?
Well, it's a good question. Again, without talking about politics, what's happening in Washington is good for the global ecosystem. There's no doubt about that. In terms of the points I've made in the past about Dubai, Dubai is 4 hours away from 1/3 of the world's population of flight. It's an 8-hour flight from 2/3 of the world's population. So we see a lot of folks expanding internationally, and Dubai is a perfect space for that. Without talking about other regulators in the EU or Southeast Asia, we've been able to position Dubai as a place where you can do different types of projects and products. We're big agnostic around business model and tech. We regulate the activity. And so for us, regulatory clarity is kind of our religion. So we kind of have highlighted what firms need to do, but how they can be commercially successful. We give them room to grow and room to run around, guardrails from not just our regulations, but I also run the supervision team around how we regulate their particular business model.
Yeah, how does that supervision work? Because you were chief compliance officer at Citadel, so you have an understanding of compliance when it comes to a very large, sophisticated firm. Does VARA actually supervise these firms in real time?
Yes.
Or, so more so than just creating rules that you're hoping they're abiding by. You're monitoring them in real time.
Oh, yes, real time.
How does that work?
Yeah, so it works in a number of different ways. I also run our blockchain analytics team. That's like our on-chain surveillance, which focuses on financial crime prevention and potential market misconduct. Similar to the guest you had from Elliptic. We use their tool, and we use a lot of the other competitors' tools. And so we regulate them from a prudential standpoint. We take financial data from them. We take customer wallets from them to make sure that we can run those through scans and make sure that they're not touching, dark web or terrorism financing and that sort of thing. And we kind of go back and forth. We do a lot of what a lot of other regulators do. We do on-site inspections and that sort of thing as well.
So, Tim mentioned that you used to work at Citadel. You have a storied career across regulation and compliance at a number of different firms. What brought you into the DeFi world? How did you make that transition?
Yeah, it's a very good question. And before Citadel, I did 20 years at Goldman Sachs in New York, Tokyo, and Hong Kong. So I've seen a lot of different regulators. I kind of have a sense of what good looks like. And so I always, at the end of my career, wanted to kind of dabble in the regulatory space. This project was presented to me, and the ability to be part of what Dubai is committed to doing in terms of building up this space as a big part of their economy, with the view that they have clarity of purpose. There's no politics around, is it good or bad? They knew exactly what they wanted to do. And so to be able to get into the space in that seat with a clear path was something I couldn't say no to.
Would you consider coming back to the U.S. and being a regulator here?
Ooh, good question.
Yeah, I would. I mentioned I'm here to pick up my daughter from Notre Dame. So, you know, I have 3 adult kids that are here. I come back and forth quite a bit. Sure, but right now I really like being in Dubai, and I like being part of this project.
Well, we like it when you come visit us, so come visit us more. Sean
Thank
McHugh,
you very much.
Appreciate you taking the time. That's VARA's head of market assurance, Sean McHugh. Here in New York, let's take a look at what markets are doing, seeing a little bit of a sell-off, especially when it comes to some of the AI stocks, at session lows right now.
It is risk off right now across the equity markets. The Russell 2000, the big loser here, are losing 2.4%. The Dow Industrial is actually holding up the best, but you've got the NASDAQ losing 2% as well. Remember, stocks were basically near record highs. That hotter than expected inflation report may be taking some of the wind out of the market's rally. This is Bloomberg.